Stanley's Betsy Graseck. She's Bloomberg's #1 ranked analyst for diversified financials in 2010. Welcome to In Business, Betsy. Good to talk to you.
Thank you, Margaret. Nice to see you again.
So are we seeing financial stocks accurately price in what's to come out of Basel?
You know, I think there's a lot of uncertainty in financial stocks right now. One of the key reasons that we're overweight the large cap banks at Morgan Stanley is that we expect that some of this uncertainty will be fading over the course of the next year.
And the uncertainty being the exact level of capital that they're going to have to keep on their books. I mean, we know that 7% level is expected, but the added 2% to 3% range that we're talking about for the largest institutions is what we're waiting for specifics on.
Yeah, I think there's a couple of areas of uncertainty. One of them is the capital Sippy Buffer that you mentioned. And at Morgan Stanley, Hugh Van Steenis, myself, and the rest of the global banks team recently talked a little bit about this in a note we published, where at the high end of the range, we think there could be a 2 to 3% incremental Sippy Buffer on top of that 7%. We're going with the 2.5% midpoint in our modeling for the banks that are affected by that. But we think there'll be some gradations for the largest 25 plus or minus banks, and not everybody will be at that 2.5% level. It'll be gradated based on size, complexity, interconnectedness, a couple of other metrics as well.
And when you say SIFI, it's systemically important financial institutions, right?
That's correct.
The too big to let fail banks that we're talking about. But there's that debate over how much debt should be convertible to equity in there, and how that capital should kind of take form. What's your expectation?
You know, our expectation is that at least in the U.S., the SIFI buffer would be all common equity. We do expect that the domestic SIFI buffer in the U.S. would be a subset of that, 2.5% that we're talking at the high end of the range. I think there's some other countries, and at my colleague Hugh Van Steenis, who covers the global banks in Europe, is expecting some of that bail-in debt or COCOs might be on top of the SIFI buffer, as they've already done and expressed in Switzerland.
Now, the thing is that the banks in the United States have been vocal about is they don't like being forced to increase capital, because they'd say, capital levels are already at the highest level that they've seen since the 1940s. How much more does this buy us, essentially, in terms of safety, increasing that?
It's a great question, and I think what you've got is two factors going on here. One is, kind of the capital you need for the bank on its own to be sufficient to be stable, best in class, et cetera, really strong capital levels. And that's really embedded within that 7% ratio that we've already, heard about from Basel. Then you've got, what does the system need to be stable, sound, secure, safe, et cetera? And that's where the SIFI buffer comes into place. Mm-hmm. I think the stocks today are really reflecting even higher levels of capital requirements than what we've put into our models. Part of the reason I say that is because, you've had some Fed Governor Dan Tarullo talk about a much wider range.
Right.
And, the midpoint of his range is 11%, not the 10% that we'd be modeling in. So, I think there is still a lot of uncertainty, and frankly, until investors see the regulators come out on the printed page with what their recommendations are, I think there's a lot of uncertainty, and I think that's what the stocks are reflecting.
Do you think that the conversation being had in Basel is the right one? Because there are those who would say, yeah, size matters to a certain extent, but it's also the interconnectedness of the financial institutions that's truly what's dangerous. It's the exposure you're not aware of.
Well, I think that's part of what's being discussed in Basel. I think the way they're coming up with the approach to how much capital to apply to each individual bank globally is a function of both size, as well as interconnectedness, as well as complexity, and there's a couple other metrics in there too. So I think what you're bringing up, the interconnectedness, is a part of the mix and the debate.
Is there a funding boost that comes from holding higher capital? I mean, Bloomberg was reporting that some of the leadership at HSBC said, hey, you call us systemically important, and that essentially says that a government would never let us fail. That's a guarantee.
This is a really interesting topic, and I do think that the funding markets are going to take into consideration a variety of different inputs including how much capital do you have, what the size, scale, scope, competitiveness of your business model is, et cetera. So, I would argue that there's a variety of inputs that funding markets are considering.
Looking at the financial institutions right now, do you expect, say, a Bank of America to have to, besides show that they can raise capital by selling off parts, but to actually go ahead and have to execute on that? Are they going to have to issue shares? Are they going to have to sell?
In the U.S. banks that we cover in the large cap bank group, we do not have capital raises in our models. We think that the banks can get to the required level of capital organically through a couple of different factors. One is they are shrinking some of the higher risk assets that carry a high risk weighting. Another reason is earnings. Earnings are growing as credit improves. And then we also anticipate that they'll be changing some of the ways that they're dealing with the trading market and trading books as you change some of the counterparty agreements to better mitigate some of the risk weights that you have on your balance sheet today. So I think there's multiple ways that you can actually improve your ratio between now and 2013. In addition, we have to consider the fact that the regulators for Basel III in general are really giving a pretty long ramp phase-in period, 2019. And look, when I take out all of the buybacks that I've got in my models, my big three banks get to 13% common tier 1 by the time we hit 2013. And we're talking about 7 plus 2.5 by 2019.
Yeah.
I'm not in a camp that says they have to raise capital. I do not think that my banks are going to be issuing stock.
All right, Betsy, thank you so much for giving us your forecast. Appreciate it.